Hi, everybody. My name is Raul LeBlanc, and I work at IHS Market, and I focus on unconventional oil and gas. I've been following it for a while, and today I thought I'd go over a couple of interesting things that are going on, because in my mind, the next year, 2020, is really an inflection point for this. I would argue that at all sorts of prices, the key system drive of shale oil and gas in the United States has been largely the same until now, right? So for about the last 10 years. Now, to start this out, I want to share my screen, and I'm going to take you through kind of an interesting exercise. So let's take a look at this. Fascinating, right? It's a dot. But what I want to talk about here is how shale has behaved and how the rest of the global oil system has behaved. And I'm going to use this chart, which I'll sort of explain as we go along the way. Up here on this y-axis, I have the oil price. It's the Brent price in dollars per barrel. On this axis, I have the change. This is the year in barrels, millions of barrels a day. This is the year 2009. So basically in 2009, the price was about $62. And so if we go forward to, say, 2010, what happened? So now we start to see, here are the different regions. I've got Canada, the former Soviet Union, the deep water provinces around the world, disrupted countries, mature areas, Saudi Arabia, the USA, and the rest of OPEC and Middle East, North Africa. So take a look. The point is, hey, all of a sudden now they went from getting $62 to getting about $80. And if I go to 2011, you'll see that continued. Now we're up at a price of 110. This is was a fabulous price. Now, the interesting part to me is the reactivity of the system. That's what I want to focus on here for a second. If you think about it, you've taken a course in economics, you say, hey, the price of something goes up, everybody's making a ton of money. That is a signal. That's a signal to each and every producer to, hey, go get more of this stuff. It's high priced, must be scarce. Go deliver more of it to the market. And so everybody ought to be moving to the right as the growth versus 2009 should start to kick in due to the high prices. So let's go through a couple more. Yeah, there's 2012. Okay, I'll play the movie because who doesn't like a movie? 13 and 14. Then, of course, the price fell down, and the price since that time has sort of lingered in the kind of, as you can see right here, all these years lingers in the 50 to 70% sort of band. And so the point I want to make, that what's the key takeaway? Well, the first thing you'll notice is actually not the blue line. Ignore the blue line for a second. The point I want to make, and the primary point of this whole thing, is this, is that over a decade, which included the highest prices in the history of commodities and the largest tidal wave of cash, most of the system did not figure out a way to take that capital, marshal it, put it back on the ground, and generate substantially more supply. Right? That is really key, because the one area that did was the U.S. And you can see here at a high price, this blue line, the U.S., by the time I got to 2014, the U.S. had already grown by about 3.4 million barrels a day versus 2009. Then the price fell, and everybody thought, including some OPEC members, that everything would slide back this way. That's too low a price. And at $50, the system is going to shrink. And it did so for a year. But then you had this. This growth spurt has been very surprising. Okay. And I would argue, and look at Canada. Canada's that's Saudi Arabia, and you can see Canada here in the orange. They've also done pretty well. Both of them are large petroleum systems, but clearly the market has really incentivized production in a massive way only in the USA, and that elasticity has been with us. And the point I want to leave you with is that notion that only North America or unconventional in particular, we'll talk about that in a second, has been able to systematically grow is an important function that determines prices and expectations and a whole lot of other things. Now, that has been the maxim here. Let's take a look at some other data here. So this is a look at U.S. production. So we're focused in on the U.S. Let's take a look and see what we see. This is the production of crude oil and wellhead condensate. So this is our oil production. And for those of you who were in the business in the early 2000s, you remember this is the period where oil prices went to $140, right? And really what you see is nothing happened. This is natural gas production down here, okay? Natural gas production was also largely stagnant, hanging out in the kind of high 50s. That's 55 BCF a day. Now, let's take a look at this and focus, make discussion a little bit more interesting. So I come here and I'm going to color this by what we call the play type. Okay, so now let's take a look. Let's take our shale. We'll throw it on top. What you see here is very important. What it suggests is that the conventional world, okay, which is really the kind of bottom three, but I'll maybe move this up here, right? That's unconventional, semi-conventional, this red. But the deal is you can see the world which was once conventional, that went through $140, back up to 100 and back down, and essentially was not rejuvenated. That's the key point I want to leave you with is high prices did not rejuvenate the U.S. system. All the work has been done, of course, is not a surprise, by these shale plays. Okay, so that's what we're going to focus on. You see it's even more dominant over here on the natural gas side, with conventional production falling off very considerably in the period over the last 10 years. So as I say, in the last 10 years, we've had the same game plan. Now what is different? What is happening? What's changing? And why do we believe that there's an inflection point coming up here? Well, I'll tell you why we think there's an inflection point. And the first thing I want to talk about is what is going on physically. And I want you to remember two things. And we've been talking about this for a while. So the first thing is well results. And the thing I want you to take away from this is that in general, wells have stopped getting better. All right, now let's take a look at this. Focus on this here for a second. This is annual curves in the Bakken Shale up in North Dakota. So in other words, this one is a 2014 well. So 2014 well peaked here at 436 barrels a day. Meanwhile, fast forward a year, and you can see the wells had a higher peak, and then we get an even higher peak. And then a huge jump, okay, and then another jump, and then even this year, we're seeing a nice jump in well production. You'd say, Raul, didn't you just say that wells stopped getting better? Yes. Let's take a look at this, and then I'll make the big caveat, right? So that is the Bakken Shale. Here's one of the big Permian plays. You can see that's getting better. Yeah. The Eagle Ford, only a little bit, okay. The Wattenberg, actually not. You can see that wells peaked out in 2017. Okay, you're not losing much, but you're not getting better. A little bit better in the Wolfcamp on the Delaware western side of the Permian Basin, and then the Wolfcamp on the eastern side of the basin. So you say, well, that looks good. Looks like we're still steadily getting better. Well, looks can be a little bit deceiving. And one of the things is this is the absolute production that comes from a well. But frankly, those wells are getting longer. So if we measure the ability to, I'll throw them all on here. Here they all are. Now if I measure the ability to extract more oil and gas per foot, okay, you'll see that actually the wells are not really getting better, right? That big bump up, except in the Bakken, which continues to improve, they're about the same. So 2014 wells were way down here, 2015, 2016, 2017, and 2018, and then 2019, right? So you're looking at a pretty big improvement in that. The next thing I kind of want to talk about is if you are in a situation where your wells are not necessarily getting better, well, the other factor that everybody has to take into account is my base decline. Yeah. So let's take a look at some base decline data if we can bring some of that up. So the base decline is the data. Okay, let me try this, and I'm going to back it up till the middle of this year. Let me do that. Okay, if I take a look at this. So what do we see here? Well, what we see here is that production in the U.S., and I'm gonna start here on this top graph. This is my onshore production in the U.S., and this is from January until December of each year. And the point I want to make is, hey, I've got a look at naturally the set of wells that are on stream by January 1st, we call the base. They decline over the course of the year. Okay. And the deal is that decline, both on an absolute basis and on a percentage basis, okay, is increasing. Yeah. And what we see is nowadays that instead of, say, the 1.7 million of treadmill speed we had to make up back in 2014 or 2013, yeah, we're now on the order of more than 1 million barrels a day, more than that. And the secret to this has been that the more wells you add by growing, the faster the base decline goes. So there's a relationship there between the two. So what I want you to remember, it can get a little tricky, is that in a particular area, the faster you grow, the more you exacerbate the kind of hangover effect. So we've been in a market, as you saw in the very first slide, where we've been growing and growing and growing and growing. What that means is that our base decline is now at a very, very high level, okay? It means if I don't feed the beast is very hungry, okay? If we stop drilling wells today, production in 12 months would be about 3.5 million barrels a day less than it is today. That's how important it is to keep drilling and adding wells. All right. So we have well productivity that's hit a plateau. It's a very good plateau. I would call it world beating, but it's not getting better anymore. At the same time, your base decline is increasing. So those are two physical fundamental facts. What it means is that the growth model that you saw in that first slide that the U.S. pioneered over the last 10 years becomes increasingly difficult unless I can throw more money at this thing. And that's where the third element of what's happening today comes into play. So if you think about that third element, it's that the equity markets have decided that this business model is suspiciously low on profitability and needs to generate profits rather than keep reinvesting all the money back into more wells to grow faster and faster and faster. It looks at the U.S. vis-a-vis the rest of the world and says, hey, the U.S. has glutted this market, this oil market, for the last several years by growing super fast, okay? It's undermined any kind of price support. And we know that these companies can grow. They have proven it to us in spades. They've looked at this. They've shown that they can really ramp up volumes. The U.S. has tripled its oil production in the last 10 years and is now the world's largest oil producer. But what we don't know is whether these companies can make money at this, or does it require a constant infusion of cash? The short answer is that in this price range, say $50 to $60 WTI price, which is about where we are now or slightly above that. But in that price range, which is where the futures curve is and the long-term expectation is, unfortunately, U.S. producers will have to choose. If they can't borrow money or issue equity, which are both markets that are closed to them now, what they can do is live within cash flow. And the hard, cold fact is that for the industry as a whole, there's not enough money coming in the door in terms of cash flows to both grow quickly and to start to show profitability and return some of that cash to shareholders in the form of profits or share buybacks or debt repay or dividends. Right? So This has become an acute crisis in the equity market for E&P companies, exploration production companies, in the last, say, 18 months. And 2020 is the year where really the rubber's meeting the road. A little bit here in 2019, but 2020 will be the year where these companies as a group are pulling back pretty hard on the amount of money that they will sink into drilling new wells. And they will take more of the money that they have, and instead of reinvesting it in those new wells, will turn around and give it back to shareholders to show profitability. Now, companies are very different. They have very different quality of assets. They have very different base decline. So there will be winners and losers in this game for sure. Okay, but as a whole, that's the direction the companies are headed, and so it's a very different kind of behavior from everything we've seen before. The fourth thing I want to talk a little bit about are the majors versus the independents. So if I take a look we hear this a lot. We hear, well, now that the super majors are there, by which we mean ExxonMobil, Chevron, Shell, BP. Now that the super majors are here and they have big balance sheets and will continue to drill through the cycle, how does that change everything? Well, let's take a look and put some numbers to this, because it's an important question. What we have here is a look at the wedge production. So when you think about the wedge production, what do I mean? What I mean is in each year is the cumulative total of all the wells that began their life during the year. So in other words, what we see here is say 2015. In January of 2015, a set of wells came on stream, and those wells produced on average 272,876 barrels a day. That set of wells plus what came on in February produced 781, right? 1,000 barrels a day, then 1.2. And the point is they're drilling wells each year, and we're adding up the annual cumulative total. That's what you need to make up for what you're losing through natural decline. And so the important thing is this is the new barrels that are being added, and who is adding them is really important. So let's take a look and throw on the operator type and see what's going on. Okay. So what do we see? Now I put the global super majors here in blue. So in other words, this is the contribution from those big companies in terms of production, results on the ground, where the rubber meets the road in terms of, hey, this is what from the new wells they're drilling in all their properties is coming out of the ground in that year. And the point is really not just to look at what they're doing by themselves, but to see how that compares to some of the other groups. Okay, so by the end of 2018, the global majors had built up a wedge from that year of 955,000 barrels a day. However, that's actually only half the size of the large independent companies. Okay, and even you have companies, mid-sized independents and small independents, and even the privates. The privates collectively, okay, are still drilling as much new source production more than the super majors. So while the super majors are important, they're very large players. There's only a few of them, and they're staking out very aggressive goals, which we believe they will be able to deliver. However, don't make the mistake of thinking that they're somehow dominating the market. Point being that if the independents and the private guys pull back on activity, okay, in order to save money and in order to slow growth and give money back to shareholders, the majors cannot carry the system and can continue to drive U.S. production growth. So to sort of finish off here, where does this leave us? Well, the point I want to leave you with is the following, just to recap real quickly. Number one, the U.S. has had a growth model for the last 10 years. Two, the reality of the situation on the ground is that well results have generally hit a plateau, and we've moved from breakthrough improvements to very incremental improvements. Number three, the base decline that we're all fighting, E&P companies are all fighting every day, that base decline has accelerated fairly dramatically. It's doubled even in the last 2 or 3 years. So a lot of production they need to make up. Fourth, the companies that are doing this are being forced to pull back on their capital spending to prove that their business model can generate profits as much as it has proven that it can grow phenomenally and disrupt the global oil market. And then five, the majors are not big enough in and of themselves, despite their strong prominence and the role you see in them in the media, to carry the U.S. and make it grow significantly. Okay. All that, when you add it up, what does it mean? And why do I say we're at an inflection point? It means that we've probably, at least for the time being in this price range, hit a point at which the U.S. will not continue to grow aggressively its supply and will actually start to moderate. And that's a big deal in terms of global oil fundamentals and what it means going forward. Well, thanks very much. I'll take any questions right now if there are any out there. Okay. Somebody wanted to know what the tool I'm using for this analysis is. So this tool is part of a data service that IHS Markit has. And the tool is called DNA. Right? And it is a look at, it contains all the wells in North America, both Canada and the US, and it tries to make them smart. It makes smart data, we process the data, and then we create a visualization environment. It allows our clients to really get in there very quickly and look at trends, understand spatial areas, they can benchmark things, and in general, figure out what's going on in the oil market. Next question. Do you expect OPEC decisions to impact North American shale production? So this is an interesting dynamic. A lot of ink has been spent on this. The way to probably think about this is the following. OPEC makes decisions which seek to provide elasticity to the global oil market. And what do I mean by that? Well, in general, you can think of OPEC as having a couple of functions historically. When there was too much supply, the elasticity of the oil market is not very good in terms of, hey, the price goes down, there should be less supply and more demand. But those kind of things take a long time. OPEC came in and said, you know what? When there's too much supply, we'll take supply off. At the same time, we will hold spare capacity such that if the world is short oil, we can again increase the supply in a relatively short way instead of saying, hey, don't worry, we're going to go drill some wells in another 10 years, we'll bring you some more supply. That's not a good answer if the price of oil goes up. We need supply instantly, or at least in the short term. And so that role is what OPEC has done. And so one of the issues it's had is the U.S. came along and suddenly was price responsive, okay? And the OPEC has been seeking to figure out how to deal with the U.S. And in the end, the OPEC decisions don't directly impact any U.S. producers. We have thousands of producers making independent decisions to do what they're going to do. What does affect them is the price. So that's the real situation, okay? Everybody looks at what is economically feasible and tries to make their best decisions from that world. Okay, I think we are out of time. We're supposed to go 25 minutes, and we've hit our 25-minute target. So thank you very much for joining. If you have any questions or want to get in touch with us, feel free to reach out to IHS Markit. Thank you.